Welcome to Ignite Finance. I'm Tajeram Mohabir, and in this episode of Ignite Finance, we have a slight twist to the program, where I'll be asking the host, Joel Bagwandin, some key questions related to ExxonMobil Consortium's reported profit of US $10 billion in 2024.
Yes, thank you. Thank you, Tajeram.
Right, thank you, Joel. And let's dive straight into the discussion. According to the 2006 Petroleum Agreement, the government of Guyana earns a royalty rate of 2% and a profit share of 50%. Explain to viewers why the total earnings for 2024 are less than the reported profit by the oil company in 2024. How does the profit share work?
So thank you for that question, Tajeram. And there's an important clarification, particularly for the audience to understand, is that the profit share that you refer to is governed by a formula as per the 2016 Petroleum Agreement, which you reference. The financial statements that the oil companies would prepare at the end of the financial year to file with the tax authorities and file their annual report and so on, for financial reporting purpose, those financials are prepared in accordance with what is called the IFRS standard. So when we're looking now when we're analyzing particularly the profit, you would recognize that Guyana earned $1.5 billion, which is less than the 50% $10 billion reported. So why is that? That is because according to the Petroleum Agreement fiscal terms and conditions, there is a 75% cost recovery. So this 50% is actually 50% of gross revenue, which is 100%, less 75% for cost recovery. So it's actually 50% of 25%. And the 2% royalty is applied to the gross sales of all the crude oil produced based on the prevailing market rate. So that's the formula, and that's how the formula is applied, and that is the explanation for the differences. Importantly to note, I want to say that as well, that in the outer years, I saw, for example, recently a letter by a group called themselves the Oil and Gas Governance Network, questioning within the public domain whether the country will have this lopsided petroleum agreement forever. And the simple answer is no. And you have to understand how the contract works. The contract has a life. The contract is not infinite. So the prospecting aspect of the petroleum agreement, for example, that governs the Stabroek block, that expires 2027. Now that means after 2027, there will be no more exploration, no more new exploration within the Stabroek block. So that then means that right now you have exploration activities as well as production activities being carried out simultaneously by the ExxonMobil-led consortium within the Stabroek block. So in 2027, when they no longer could explore, when the exploration license expired, whatever discovery they would have made up to that point, that is the amount that they will be limited to, restricted to producing for the remainder of the production licenses per field, right? And that is why it is important for them to ramp up production, which is aided by the government policy to ramp up production. Now, if you look at that, obviously means they will have to relinquish a large percentage of the Stabroek block. To give the viewers an idea of how much that percentage is expected to be based on my own assessment of the size of these fields, the area of these fields, those that are currently in production, those that licenses were already given by the government, and those that are in the pipeline, it would be less than 10% of the, I think it's about 24,000 square kilometers, Stabroek, less than 10% of that. So we'll be getting back at least 90%, at least, let's say, a little bit more conservative, between 80 to 90% of the Stabroek block unexplored. Now, why I'm explaining this in relation to the profit that we will get in the outer years, when those costs are recovered, when all the costs, because remember they're continuing their investment into developing future projects. By 2030, we know publicly that we were expected to move production from where it is currently, to which is about over 600,000 barrels per day, to just over 1.3 million barrels per day. When all those costs, initial capital investment costs, are recovered, Guyana's share of profit will significantly increase to about from 12.5% of gross revenue to about 25 to 30% minimum, or conservatively by then, which, all things being equal today, price and cost estimates and production level and so on, all things being equal, that will generate on average about $8 to $10 billion US dollars profit for Guyana, up from $1.5 billion.
Right. Thank you, Joel, for that comprehensive response. Now, experts and commentators have consistently argued that the lack of ring-fencing provision in the petroleum agreement is shortchanging Guyana's upfront profit earnings. Now, what is meant by ring-fencing provision, and how does this impact Guyana's share and other implications?
So, first let me say that, specific to that question, is that the oil and gas industry globally is very dynamic, very dynamic. And it's a global industry, emphasis on global industry. So what takes place in one market, as in the case of Guyana, would impact the rest of the global industry. Now, in 2016, you'd recall that there was a lot of criticisms, including from the opposition then, which is now the government, about the lack of these very provisions in that agreement. And what it does, ring fencing simply means within the oil and gas fiscal framework, there is one large block called the Stabroek block. In that block, it is developed in different phases. So they carve out, you have like a subset of different fields. So for example, you have Liza 1, Liza 2, Yellowtail, Payara, and so on. Those are different development fields or project area. Now, each field within the Stabroek block is licensed separately under the 2016 agreement. Now, the project economics for each field are sometimes unique to that field, because the volume of resources in a particular field might vary from another field. The cost to develop one field might vary from another field, or would often vary from another field. The break-even cost for one field would vary from another field, and the profitability that you generate from one field would vary from another field. So ring fencing means that the profit earned from Liza 1, for example, should not be used to finance Liza 2. We should not take Liza 1 money to reinvest, to finance phase 2 and phase 3, and because when you do that, that's how we get a lower profit share, which is, instead of 30% of gross revenue, when you apply the 75%, we're getting actually 25%, because there's that 75%. So we're getting less profit upfront, owing to the high cost recovery, and because there is no ring fencing, which means the oil companies are permitted to take the revenue generated from one field to finance the other field. So that is what ring fencing is about, to ring fence those fields. We should take all the profit from this field and separate that. Fast. Now, within this dynamic environment, however, there has been a lot of development globally impacting oil economics, particularly because of the 2016 fiscal terms. Because, and to summarize what I mean, because we've had an extremely favorable fiscal term to the oil companies in 2016, that impacted the global industry, the global market, to now other countries, other oil producing countries, it made them less competitive in the market. And so if you study the literature and study oil and gas fiscal frameworks across the global industry, you would recognize that there has been a consistent effort across market to liberalize their fiscal framework such that it becomes more competitive. And that stemmed from the fact that you had a new kid on the block called Guyana with this favorable fiscal term. So that is one component. Another component is that since then, with all the events that took place in the world, COVID, pandemic, regime change, change in policies and so on in the United States, etc., the cost of financing is today more expensive. The cost of oil, and that coupled with climate change policies globally impacting, negatively impacting the cost of financing for the oil and gas sector. So if the cost of capital on the market, raising capital in the market is more expensive, the cheapest source of finance is from your internal source. So in financing, there are internal sources of financing and there are external sources of financing. Internal is generated from liquidating the company's assets and from your retained earnings, from your profit. And 2, your retained earnings and profit, and 3, your operating cash flow. Those are internal sources of financing, which is cheaper than external sources of financing. So because of the lack of ring fencing, that is now working to our advantage. In fact, let me frame it this way. Because of that, the policymakers, as shrewd as they are, and credit to them, they have flipped that into a positive to ensure that although we have the lack of ring fencing, it is really not shortchanging the country, but it is not a shortchange or foregone revenue. It is really a trade-off. It is a trade-off to take this money, to take the excess money, to quickly ramp up our own production, to finance, to reinvest the dollars in our own market, reinvest the profits in our own market, to develop the resource. And in the outer years, we will get that in the outer years. So if you do the analysis, which I did, you would see that because the extent to which and the pace at which we have ramped up the level of production and taking into account the timelines of the expiration of the exploration license and so on, and the project economics of the various fields, it is not a short change. We will get back that money. It is actually a positive trade-off in our favor towards the outer years, say by 2035, thereabout and thereafter.
Yeah, thank you. So my next question to you, are oil companies actually walking away with US $10 billion? Or are those profits being plowed back into the economy?
So the short answer is yes, as I just briefly alluded to, but I want to elaborate a bit because for the benefit of the viewing audience, there's a misconception that over the past 5 years dominated the public domain. This misconception is that this profit that they report every year, which, as I just explained, the technicality there, the differences in one is in accordance with a reporting standard, but in terms of the profit share, it's according to the formula in the agreement. Two different framework, right, for the different purposes. This misconception about the oil companies walking away with the profit, it is really not true. And that is simply because they're plowing back that money into developing the resources in the Stabroek block so that we could maximize production and maximize, in turn, maximize our earnings. Now, here are some interesting points to note in relation to that. If you look at the cash flow analysis, you would see that the cash flow analysis will show you that the oil companies are in the negative. They are in a net negative position, meaning the profit is now going out to the parent company to pay dividend. They're taking 100% of their profit together with additional capital injected from the parent company into the market. And that is for 100% of our benefit. Not a cent of the profit that they declare goes back to the parent company to pay shareholders dividend. And this is something that has not been put out there or explained to the viewing and reading public, or the general public, I should say. So that is why I say it is a misconception. It is a grave misconception.
All right, thank you. So considering price volatility and the impact of climate change, assuming prices fall below $50 per barrel, how will that impact Guyana's revenue? And what might be the future implication for the industry in the long term in terms of sustainability?
Guyana, there is this notion in academic literature that oil could be a blessing or a curse. It is up to that country, the people, and the government to make that determination on whether you want it to be a blessing or a curse. Thus far, from my assessment, comprehensive assessment, I would say it is a blessing for us. And we are blessed on many fronts. Our crude oil is the most attractive on the global market. Why is that? Because it is the light sweet crude, which means it carries a premium price on the market over the heavier crude. And the break-even cost for our oil is among the lowest in the world. Now, if we taking into account climate change policies, I have looked at all the oil producers based on information that I could have, based on as much data that I could have collected on the internet. I did an analysis looking at the average break-even cost for maybe 99–95% of the oil-producing countries. The average break-even price globally is about $50, $45 to $50. Some countries break-even is $60. Some countries break-even range between $30 to $40. Our break-even cost is less than $30. So that means two things on a global, in terms of the impact on not just our economy, but the global impact and sustainability in our context. It means two things. If oil price is to fall, I will go lower than your $50. If it is to fall below $30, below 30 and stays between $25 to $30, more than 50% of global producers of oil will become unprofitable. More than 50% of global producers of crude oil, if oil price is to fall in the long run, to that level, more than 50% will become unprofitable, therefore will no longer attract investment, therefore will go out of business. And that means you will have, you will still have a market to supply long into the future. Despite climate change and all of that and renewable energy, you will still have a market to supply if 50% of oil producers go out of business, if oil price collapse to $30 and $25. Guyana will be one of the few countries that if prices go to $30 or $25, because of our low break-even cost, we will still be profitable. So in terms of long-term sustainability, the impact globally will be twofold. 50% of countries will become unprofitable and non-sustainable, which will create that space and sustainable demand for countries like ours to continue to supply that market, and which means because of our low break-even cost, our industry, our crude will still be profitable. Of course, so that's in the long-term sustainability. In terms of impact, of course, oil price, as you mentioned, is volatile. It goes up and down every day. And when we started when oil was discovered in 2015, oil prices was averaging $50. Today, it's $70, $80, $60. Even if we go down to $30, $40, $30 with a low break-even point of $27, $25, and it will get lower. It will get lower because as we ramp up production, you benefit from something called economies of scale. So the cost to produce a unit will fall as you ramp up production. So because of economies of scale, as we ramp up to 1.3, our break-even right now, which is $27, will go below $27. So that would be the impact for us in terms of revenue and in terms of long-term sustainability.
Yeah, thanks. That was a very informative response. Now, what is the impact of earnings from the petroleum industry on the macroeconomic framework? And we'll include the national budget here.
So right now, as I've established in my answers to the previous questions, right now we are just getting about the 50% profit, and when you apply the formula, the 75% cost recovery, and you share 50% of 25% of gross revenue, which is what remains, works out to 12.5% of gross revenue. And when you add a 2% royalty, that's about 14.5% of gross revenue. That's what we're getting right now, which, based on price and based on how we're ramping up production, has moved from 2019, December, from 2020 when we started producing forced oil, from 300 million to 600 million to a billion, and now 1.5 billion and 2 billion. And that's because production has moved from 120,000 barrels per day to now we're doing over 600,000 barrels per day. By the end of the year, we should surpass 700,000. By next year, we should touch 800,000. By 2030, 1.3 million. So because of that and the timing factor, how we're scaling and how the earnings will increase, the impact, the revenue generally is modest. It's not anything fantastic. It's modest. The impact on the budget is such that it only finances in the previous year's budget, in 2023 budget, it was less than 30%. It accounted for less than 30% of financing the budget. In this year's budget, 2025, it's just about 30%. Just about 30%. So that means 70% of the source of funding for the budget comes from other sources, such as the non-oil sectors, the non-oil tax revenues, and to a lesser extent, you have the proceeds from the carbon credit sales, and the difference is what we borrow. The deficit is what we borrow. So the impact on the macroeconomic framework in terms of the budget it accounts for just about 30%, financing 30% of the budget. The impact on the economy, it has allowed for our economy to grow, to have grown quite exponentially from first oil to now, where GDP has moved from just about $4 billion before we started producing oil in the pre-oil era to now over 20 billion. Nearly 25, we should be touching about 25. Our GDP will be touching close to 25 billion US dollars this year.
All right, thank you, Joel. It has been a very informative discussion, and it was great to having you here.
Thank you.
To our viewers, join us next Tuesday, where we continue the discussion on matters of finance. And thank you very much.